This is Brent with Trade Therapy, and welcome back to the Trading Couch. We're talking about Cathie Wood's ARKK today. That's a great case study in how institutions manage high beta growth and innovation risk around a shift from tightening monetary policy into an easing cycle. Before we get into the charts, a quick disclaimer: this video, as well as all Trade Therapy content, is for educational purposes only. It's not investment advice. Trading involves risk, including the risk of loss. Always do your own due diligence and trade according to your own plan and your own risk tolerance. If we take a look back to September, ARKK had really done something that we hadn't seen it do since COVID. All of the weekly moving averages are stacked bullishly. The shorter averages are on top of longer averages. They're all curling up and beginning to fan out, with price respecting the shorter term averages. These are all conditions that were present during ARKK's prior markup campaigns: bullish alignment, all sloping up, fanning out, with price respecting the shorter term moving average and not coming back and collapsing through it. Back in September, we did expect to see price get up into an area where we should expect to see some congestion coming in from overhead supply. But the important part was that the early stages of a new markup phase were visible while policy was still restrictive. The Fed hadn't opened up the liquidity gates at this point the way that we're starting to see now. That means institutions that were stepping back into ARKK at this point were not chasing some AI headline. They were taking measured risk while money was still expensive and sentiment was still very skeptical. If you think back to the first campaign and into 2021, this was about maximizing exposure, but money was practically free. ARKK gave institutions one decision that allowed them to load up on high growth, high beta innovation assets as long as liquidity stayed abundant. When policy started to tighten, that bet flipped, and ARKK became the fastest way to dump high beta and growth and innovation risk, which is why the entire markup was surrendered during that tightening phase. When funding gets more expensive and capital is harder to raise, larger institutions don't want a lot of exposure to companies that might need to go out and raise funding at bad prices. That's when they want to get out of high beta themes and move back into the safer parts of their book, like the Mag 7. So that unwind drove ARKK down into this multi-year base. That base in 2022 and 2023 is where professional money had to answer the hard question, which was, is high growth and high beta exposure dead money? Or was it still worth owning, just sizing up at different prices? And that quiet accumulation right there was really the answer. They didn't walk away from the high beta growth or innovation space. They just re-underwrote it. The fanning out of the weekly averages in 2025 really marks the moment that in the decision where ARKK stopped being a salvage project and started turning into a tool again that institutions could use to get exposure to high beta and high growth as friendlier policy regime began to take place. They could do that without having to rebuild a bunch of single name positions from scratch, but they could rotate into ARKK and basically get basket exposure to growth and innovation within one liquid instrument. One of the cleanest ways to see how a preference shifts over the cycle is to look at the ARKK and SPY ratio chart. This really tells you in relative terms whether larger institutions prefer broad high beta exposure through an index, or are they choosing to lean into innovation at the margin. Over the prior cycle, this ratio really traced out impulsive and corrective Elliott wave structures. The green impulsive phases matches periods of easier policy and looser financial conditions when it made sense to shift more equity exposure into innovation and into high beta growth. During those legs, K consistently outpaced the S&P 500. In simple terms, Cathie was beating the mega caps while money was cheap and liquidity was deep. The red ABC corrective phase captures the opposite environment. As policy tightened and funding became more expensive, institutions cut innovation exposure and moved back into their core index positioning in the Mag 7. The ratio rolled over and stayed weak. ARKK underperformed the S&P 500 because high beta names were part of the book that could not afford a long stretch of missed numbers, and they would be forced to go out and raise capital. Institutions were looking to limit exposure. That's why you see this long slide in the ratio followed by a long drawn out accumulation period. The same players that were stepping aside during the peak were rebuilding positions in growth and risk at much lower prices. They wanted exposure again, but on their terms that lined up with the new reality. What matters now with this recent turn up after this final spring low and the ratio started to push higher, you can really treat this move as the early stages of a new outperformance campaign where larger institutions are beginning to lean back in, high beta and high growth, as they expect the Fed to add liquidity and ease financial conditions. This environment really makes the upside of growth and high beta stories more attractive, and it increases the appeal of innovation as a complement to core S&P 500 exposures. So from here, the ratio really becomes a live read. If it can hold these rising moving averages, and if it can hold this wave two pullback here, and then use all of this support as a springboard up into wave three here, then we're going to see Cathie and high beta and growth outperform the S&P 500. If it's not able to do that and it falls back into this structure here, then that tells us that high beta, high growth needs more time. Wall Street and institutions want to build a larger position before they're ready to sponsor it and push it up into an outperformance campaign against the S&P 500. If we jump back over to our current weekly chart, you can see how the story is really playing out in real time. ARKK is pushed up into what we refer to as a high participation zone. That's where these older holders that bought the top are looking to get out. We did see the congestion that we were expecting. This is an area that is full of legacy supply. So it's interesting because now institutions that built this base are now up here negotiating with the last cycle. Every rally into this zone really invites old holders to sell into strength. And so every pullback to these rising averages really tests whether or not fresh demand is willing to step in and buy what those sellers are offering. So the key question is whether new sponsorship is strong enough to absorb legacy supply and keep this structure intact. And if ARKK can hold above this recent breakout area and keep respecting these rising weekly moving averages on pullbacks, it signals that larger players are comfortable turning ARKK back into their preferred exposure into high growth and high risk on top of their S&P 500 exposures. If it slips back into its old base here on higher volume, it tells you that the overhang of the first cycle is still too large and that innovation will need more time to build up meaningful size again. If we jump over to our daily chart, the question of whether or not ARKK is in an uptrend has really been settled. That decision came after this deep flush back in April and May and this violent reversal that pushed price up away from that base. It dragged the shorter term moving averages with it, including the 55 and 200-day longer averages. This is not what a dead theme looks like. This is what the first leg out of a base looks like. It cleared obvious resistance, turned these moving averages higher, and showed that buyers are now willing to step back in and pay for high beta growth and innovation exposure again, because they believe that the policy backdrop is improving. So what's changed is really how we're viewing this daily chart. At the start of this, the task was really to prove that the bounce was real. Now the task is to evaluate these pullbacks to see if Wall Street and institutions are adjusting their size and refining their exposure. And that's what we're beginning to see. We're seeing high volume coming in at these pullbacks and at these lows, indicating Wall Street is now leaning into it and using the weakness to add and rebalance their exposure as the policy narrative shifts from tighter for longer towards easing. And so if this new campaign is going to mature, we should expect to see this daily chart work that process. We should not expect to see a sprint straight up. We should expect to see it work its way through these Fibonacci levels, expect to see pullbacks to the moving averages. If ARKK can keep doing that while the weekly structure holds and while the ARKK ratio stabilizes and turns up, It will confirm that the ETF is playing its intended role in the easing cycle. If, on the other hand, if ARKK starts living back down here underneath its 55 and its 200 and falls back into this structure, that would say that the springboard for this campaign wasn't strong enough yet, and that the weekly rebuild still really needs more time and more accumulation to pull this all back together. Back to our weekly chart, it ARKK is really a great visible example of Wall Street and what their expectations are from a monetary policy perspective. As they lean into high beta, higher growth, we should expect easing monetary policy to continue. And we're really seeing similar behavior across the entire growth and risk complex. ARKK just sits at the center of it. And really, the situation for Cathie and ARKK is completely different now that we're starting to see monetary policy changing. And it's back to being an instrument for Wall Street and institutions to gain exposure into high beta and high growth without going in and taking individual name positions. They can take a basket approach. That's all the time we've got for ARKK this week. We'll see you back here on the Trading Couch next week.